Well, the markets try to lock in a third day in a row of gains. One market bear is sounding the alarm. David Stockman served as director for Office of Management and Budget under President Reagan. He joins us now on the phone. Welcome, David. Always good to have you on the program.
Glad to be here.
It appears that you're becoming even more bearish than when we talked to you last time, so I want you to walk us through it.
Yeah, the longer you go on, I call it a daredevil market. It's all risk and very little reward in the path ahead. And I would say there's five headwinds. Number one, Trump is completely unhinged, kind of 18th century mercantilist protectionist. Nothing like this we've ever seen in the Oval Office before. And unlike everything else where he has to go to Capitol Hill, on this he doesn't. There's any kind of surprises that may wake up some morning when the tweets come. So Wall Street, I think, is being smug with the idea that he's all bark, no bite, and I think that's a huge mistake. Second, the Fed is in the middle of launching a radical change pivot to QT like we've never seen before. I think 3 or 4 hikes isn't the issue. The issue is they're going to be draining $600 billion out of the market through QT beginning in October. Now, people say it's all priced in. We know it's coming. No, it's not. If you're heading towards a cliff at 100 miles an hour, you may know the cliff is there. It doesn't mean there won't be an accident when you get there. Now, my point is that as recently as 2002, the entire balance sheet of the Fed was $600 billion. They're going to be dumping that much into the bond market on an annual basis beginning in October. At the same time, fiscal policy is utterly out of control. They're going to borrow $1.2 trillion in the year just ahead, fiscal 19. So I call it the mother of all collisions in the bond market. $1.2 trillion of new borrowing, $600 billion of old bonds being dumped, $1.8 trillion of homeless paper that has to find a home. I think it's a yield shock. I think it's not even remotely priced into the market. Finally, we're in month 108 of this expansion. 11 months from now, it'll be the longest in history. What happens then? No one's abolished the business cycle. Right around the corner, there's a recession, and earnings will drop by 30, 40% like they always do. And this market is just way, way overpriced for reality, which, is defined by these factors that I've just indicated.
All right, David, let's try to take each one of those one at a time. Let's start with Trump being unhinged. You may not like how he does things, but a lot of folks out there would argue he is getting things done. In fact, it's the tax cuts right now that are kind of having an impact on this market, keeping markets supported.
Well, I think that is really short-term and silly. These tax cuts are going to add to the deficit in the 10th year of an expansion. It's just irresponsible, crazy. The impact on yields down the road and driving the carry cost of our $21 trillion of debt higher will massively outweigh any short-run impact. It's all going to stock buybacks and M&A deals anyway. That doesn't cause the economy to grow. It's just a short-term boost to the stock market that doesn't last.
David, you've been calling for a bear market for quite some time. Some would say eventually you'll be right. Give us some timing. Tell us when you think the tide will turn.
Well, I don't know. It turned in 2002 after 8 years. It turns in 2007 when we were in the Goldilocks world. After 7 years, we're about 8 or 9 years into this expansion. Everything is crazily priced. I mean, the S&P 500 at 24 times at the end, tippy top of a business cycle with recession ahead. The Russell this morning is trading at 90 times reported earnings. I mean, it's crazy. So when the catalyst finally comes, it's hard to say, but I did hear the head of the Bank of India this morning squawking, complaining that the Fed's QT is going to upset the entire global apple cart because it's going to cause a dollar shortage. So, I think there's some huge surprises lurking out there because we've had 8 years of monetary expansion that is just off the charts of history, and trying to back away from that and unwind and go into shrinking the balance sheets both here and possibly in Europe as well. is not even remotely priced in my judgment.
Hey, David, Jeff Kilberg here in Chicago. I have a quick question for you, and I don't necessarily disagree with a lot of your points you bring up, and we certainly are running out of runway, but is there a certain catalyst that you see? Is it going to be some trade tariff? Is it China? Is there some real pressure point? Because right now, the runway, which this this plane is still flying down, it's intact. So give us the catalyst, and more importantly, how big of a drop in the S&P 500? What is that percentage drop you're talking about?
Well, I think the S&P 500 could easily drop to 1,600 because earnings can drop to $75 a share the next time we have a recession. So I think that's the risk that you have. Second, I don't know. No one can ever define what the black swan is because that's why it's called a black swan. I would say this one is an orange swan. It's that big shock of orange hair sitting in the Oval Office. And I've been at this a long time, since 1970. Nothing like this before, and you better be ready for surprises. And the idea that you're trading a perfect future and that there are no clouds on the horizon and no surprises at this, incredible level of valuation, I think is a gigantic strategic mistake unless you're following the market every second and you're smart enough to see the big orange swan finally hitting the decks.
Hey, David, it's Anthony. It's Anthony in New York, David.
Sure.
Isn't the fact that the U.S. is the reserve currency of the world, doesn't that give us insulation against a lot of the problems that you're talking about here? It seems that you'll find somebody to always buy our debt.
Yeah, there's somebody always buy it. Markets, by definition, clear. The question is, do they clear at 1.3 on the 10-year like 2 years ago today, or 2.2 on the 10-year like a year ago today, or 290 or 4, as Jamie Dimon said, is very likely a while back, or even higher? I tell you that a world where the market is clearing at 4 or higher on the 10-year is a totally different world than the one we're in today, because it'll upset everything. Stock buybacks will stop. Earnings will be hit by $50 a share. No one takes account of this on Wall Street, but if you stabilize the 10-year at 4% yield, which is not my numbers, Jamie Dimon, J.P. Morgan, earnings will drop after tax by $50 a share compared to where they were in 2016. Has anybody got that factored in? I doubt it.
All right, David Stockman, thank you so much.
Great, thank you.